Hey guys, in this lesson, we're going to look at the statement of retained earnings. This is one of the 4 financial statements that we talked about a couple of lessons ago when we talked about what makes up what we call the financial statement. So let's get started with the statement of retained earnings. The statement of retained earnings provides users a reconciliation of the retained earnings section of the balance sheet. So that's what it does. We're just going to reconcile the retained earnings on this statement so that it matches the balance sheet, or needs to match the balance sheet that is going to be prepared later on. So let's take a look here, kind of an example. So remember what we said about retained earnings and net income. So a company makes money. So for instance, they make $1,000, let's say, of net income, right? So they make $1,000 net income at the end of the year. Now they've got 2 decisions to do with that money as a company. The first thing is they can distribute it to the shareholders. So I can take the $1,000 of profit and then pay my shareholders the $1,000. Remember, that is called a dividend. It's not an expense. So I can give them $1,000, which means that all the profit is now gone because that's been given to the shareholders. And if you are just learning business and accounting for the first time, you might think that's the greatest thing in the world, that if a business makes $1,000, I can take $1,000 and I'm $1,000 richer. But there is another option. That other option is that the company can decide to retain the profits and reinvest in themselves. And so that's a good thing, right? Because if we just stay with the status quo, we don't grow. And if we don't grow, we don't make more money. So if we're like Amazon took losses for a long time, not because they were taking losses, because they were reinvesting in themselves. And so they don't necessarily pay a dividend to their shareholders because they need the capital to keep reinvesting to become a bigger company, to make more money, and hopefully it'll pay off in the future for those shareholders. So they can retain the profits. We call that retained earnings. So here's kind of the example here. You've had $1,000 net income in your company. You now decide that you're willing to part ways as a company with $400. So $400 gets paid to the shareholders in the form of a dividend, which means how much does a company keep for themselves to reinvest in themselves? $600. So $600 will go into what we call retained earnings. Now, this is all just paper movement, right? We don't actually take $600 out of the bank account and put it into a different account. The company just keeps the $600 in their bank's account. But this is kind of just a paper movement that we do. So $400 gets distributed to the shareholders. $600 stays within the company. The company uses that capital to reinvest in themselves. Now, is there any time where a company decides that they don't want to invest in themselves, but they still keep it? Absolutely. Maybe they need this just as cash flows, right? So the risk that you'll go poor is that you don't have cash on hand. Well, company might decide that they're not going to take this and reinvest in themselves. They're just going to take the $600 and keep it in their bank account. That way they create a buffer so that if they become cash strapped, they've got that $600. Companies do it all the time. It's called cash management. So that is one thing that a company may do with that, not necessarily reinvest, but keep it for themselves so they have cash on hand just in case a downturn comes and they need that cash to operate through that downturn. Smartest thing that they can do. So that's kind of what we're talking about, retained earnings. So that $600 becomes retained earnings. The earnings that the company has decided to retain for their own use, whatever that might be. So the retained earnings is the amount that a company retains to reinvest in its own operations. For shareholders, this amount represents an undistributed amount of profits to shareholders. So can the company go back next year and distribute that $600? Absolutely. So that $600 will get distributed to the shareholders next year. So now the shareholders have $1,000, and then the company has more profits from that next year's operations. So can they be distributed later on? Yes, they can. So that's why we call it undistributed amount of profits, because they can still be distributed later on to their shareholders. They're just not being distributed at all. Does that mean, does it have to be distributed? No, dividends are not required. You don't have to actually pay this out ever again. The company just could keep it for the longevity of it. But remember, you're a shareholder. You own the company. You probably want the company to keep the money so that they have cash and they can reinvest in themselves. So it's not a big deal that they only gave you 400 versus 1,000 because you still own the company. You still own ownership shares in the company. And really, what at the end of the day, what happens is if the company has this, technically the stock price goes up because they have more assets, more capital, meaning that they're less risky of a business because they don't have debt. They're just keeping their money and using that to fund themselves. So net components. So how, we talked about retained earnings. So how does this statement get put together? So here are four things that go into the statement of retained earnings. The first thing is we start with this beginning balance. So we take January 1, for instance, the balance of retained earnings. January 1 is the beginning of this year, but it's also the ending of last year. So beginning of this year, ending of last year. So we take that beginning balance, and from there, we'll add net income for the year or the period. So we'll figure out what the period in net income is, and we'll add that to the retained earnings. So if we said the retained earnings started with, let's say $100, and in our example, we said that our net income was 1,000, we now have 1,100 in retained earnings. Then from there, we're going to subtract what we call dividends. So in our example here, we had $400 of dividends. So we have 1,000 from prior year, 100 from prior year, $1,000 in net income during the year. We're going to distribute $400 to our shareholders, and then we get our ending retained earnings. So we're reconciling our retained earnings by the end of the year. So at the end of the year, we have $700. So 100 of it was prior year profits. 600 was this year's profits that we've retained in the company. That makes sense, right? From the last couple of slides ago, $1,000, 400 goes to shareholders, 600 stays with us. Well, that 600 stays with us, but what also stays with us? The $100 from before. So our ending retained earnings balance is $700. Here's a look of what that statement looks like. So we've got every statement should always have the who, company A, the what, statement of retained earnings, and the when. So this is the as of December 31st, 20x1. So notice here we've got the beginning balance of $50,000. The company earned $20,000. They've distributed $40,000. So they distributed the $20,000 of profit this year, but they also distributed $20,000 from a prior year profit, which is fine as long as you have some type of profit, whether it's retained earnings profits from a prior year or undistributed profits from a prior year or this year's profit. As long as you have that, you can then pay a dividend to your shareholders. So in this case, we're going to end the year with $30,000 of retained earnings. So when we look at the balance sheet, that's what we should see on the balance sheet at the end of the day, $30,000. We've now reconciled all of the changes that happened during the year. So that is a look at the statement of retained earnings. I know there's a lot there, but really what you should know is we start with the beginning balance. We add net income. We subtract dividends that we've paid to shareholders to get to our ending retained earnings balance. On the statement, you saw the statement is very simple. We've got the header, the who, the what, and the when, and then we've got basically that same equation. We've got beginning plus net income minus dividends equals ending. What happens if you don't pay a dividend? Well, if you don't pay a dividend, then we don't have a dividend line. What about if we don't have any income? We have zero income, which would be rare. Then you leave that off. What about we have a net loss? If we have a net loss, just turn the number to a negative. So instead of a positive 1,000, it was a negative 1,000. So we'll put net loss, add net loss, and then we'll put a negative 1,000. It should be subtract, but you get the point. So add net loss, so subtract 1,000, and so then we'd still flow the same way. As long as we have a positive number at the ending balance of retained earnings, then you can pay dividends. So regardless if we've got a loss this year, but a profit the prior year, we can still pay a dividend this year, even though we have a loss this year. So that's the statement of retained earnings. Hope you enjoyed this lesson, and we'll see you in the next video. Hey guys, it is Patrick. Don't forget to press the like button and share this video with someone who could get a lot of use from watching this lesson, like maybe a classmate or maybe a friend or maybe just a parent, just because you wanted to share this video because you're very excited about what you saw. Share it with someone. And if you want to help us grow and help us make sure that we put the very best in accounting topics out on YouTube, make sure you press the subscribe button and turn on that notification bell. That way you're alerted every time we post videos to this channel. Now, I do this with every one of my classes at the end of class. What did you learn from this lesson? Put that in the comment section below and I'll respond to you on what you got out of this video. So hope you enjoyed this video and we will see you in the next lesson.